Rallying markets after a dismal day yesterday. On Tuesday, the markets this morning are up better than 200 points. Coming back from that big sell-off yesterday amid the weaker-than-expected manufacturing data. The sector shrinking for the first time since 2016, according to the ISM index yesterday. Economists blaming heightened uncertainty in global manufacturing to the heightened trade tensions with China. Joining me right now is the former chief economic advisor to George W. Bush, Ed Lazear. Ed, it's always a pleasure to see you. Thanks so much for being here.
Nice to be with you, Maria.
So it's
Thank you.
Back and forth every day with these markets as investors react to every word coming out of China or the U.S. How do you see things?
Well, if you look at where we are right now compared to where we were a year ago, I mean, the reality is the numbers, almost all the numbers are weaker today than they were a year ago. So, it's not quite as rosy a scenario as it was in 2017, but we're not in a disastrous situation right now. What the market is basically telling us, and by the way, when I say the market, there are a couple of measures of what the market is thinking. People have been talking about the yield curve a whole lot over the past few weeks. But in addition to the yield curve, you simply want to look at the stock market. That's forecasting. It's not forecasting a recession. It's actually just forecasting slow growth. Right now, that if you use the S&P 500, which is the one that I use, that's the best indicator of where we're going over the next 4 quarters. It's showing somewhere around 1.5% to 2% growth. So not a recession, but not spectacular breakout growth. The yield curve, again, is somewhat more problematic, but that's something that usually forecasts up to 2 years in advance. So it's not clear that that's telling us that we're in imminent danger right now.
But what's ahead? I mean, look at the dollar touching the highest level in more than 2 years amid this constant gloomy outlook that we're hearing about the economy and the uncertainty over trade. Is this going to cut into earnings, cut into economic growth, and be one more pressure on overall economic activity?
Well, I think it is. And I think all of these things are, again, we're looking at things slowing down. So remember, what does a recession mean? A recession simply means that we've passed the peak. And so the question is, are we going to hit a peak sometime over the next 2 years? And the chances that we are, probably 50-50. So what you're basically seeing is the slowing as you get close to the top of the peak. You see that in a number of the indicators. Look at the labor market, for example. We know last year the labor market was creating about 225,000 jobs a month. Now we're down to about 150, 170. Still not bad, still on a recovery pace, but slower than we were last year. Look at investment. Investment has slowed. Look at manufacturing. You've been mentioning that a good bit in your program this morning. Manufacturing has slowed. One of the things that's important to recognize, by the way, is that manufacturing, retailing, and construction account for about 50% of the job loss when you go into a recession. So it's important to keep watching those sectors because they do foretell the future.
Yeah, which is why central banks across the world are stimulating. We know that the European Central Bank is in favor of a stimulus package. It could include a rate cut, tiering, and new guidance. The ECB president told us that they are looking for more stimulus. The Boston Federal Reserve President Eric Rosengren, meanwhile, said he doesn't think an interest rate cut is needed in the United States at the moment. So when you look across the world, you see all these central banks stimulating, and you see the 10-year in the U.S. at below 1.5%. It's a big month for central banks this month. What should we expect, and what's the impact?
Well, when you look at you mentioned the 10-year rate. So let's think about the yield curve for a moment. You basically have two sides to the yield curve, right? You have the long-term rates and you have the short-term rates. And what the long-term rates generally indicate is expectations about the future. So when long-term rates are low, essentially what that's telling you is that people don't think that the future is quite as rosy as it was, as I said, maybe a year ago. When you look at the short end of it, what that's telling you is that the Fed is in a contractionary mode. So if you look back to the previous 2 recessions, And you say, what happened? Actually, long-term rates were not low. They were actually pretty high, but the short-term rates were even higher. So right now we're in a situation where long-term rates are low in absolute terms, but as you've just pointed out, they're not low relative to the world capital markets. You know, the 10-year is at about 1.5% here. Look at what it is in Germany. It's negative 0.7%. Right. So in relative terms, we're still pretty high on those long-term rates. And so the question is, you know, where should we be going from here? It's interesting that the Fed is having this debate right now, and not all the players are the ones that I would have predicted actually being on the different sides of it. So it is quite interesting to be watching this.
Well, you're right. There's a division within the Federal Reserve, and even Bill Dudley, the former president of the New York Fed, is answering backlash on his scathing op-ed last week with the new one in Bloomberg this morning, and here's what he's saying. What I meant when I said don't enable Trump, writes Bill Dudley. He says, as I saw it, the combination of the trade war and the president's attacks on the Fed threatened to put the central bank in an untenable position. President Trump was shifting responsibility for the downside risks from his trade war onto the Fed. I thought this was an important issue worth exploring. He writes this today because he got so much backlash on that op-ed that he wrote last week. Your reaction to what Bill Dudley is trying to say?
Well, you know, I mean, in terms of his personal situation, he's a, you know, private individual now. He can say what he wants. The Fed should not be thinking in terms of politics, certainly in terms of affecting elections. That would be an absolutely terrible precedent. If I'm the chairman right now and I'm looking at the situation and I'm saying, you know, what should we be doing? There are basically two kinds of mistakes that the Fed can make. The first is cutting rates and then after the fact wish you hadn't. The opposite is refusing to cut rates and then after the fact wish that you had. And it's probably thinking the second danger is more pronounced than the first one right now. The downside associated with the second one is probably more significant. So if I were Chairman Powell, I think that's how I'd be thinking about it, trading off these two kinds of mistakes that you can make and thinking about which one is going to be more detrimental to the economy. Obviously, you don't want to make either mistake, but if you're going to go one way or the other, my guess is that they're thinking toward being a little bit more lenient right now, and they're not worried about the politics of the election.
But where is this headed? I mean, yesterday we had factory data, which obviously showed that the manufacturing and the factories shrank for the first time in 3 years. Then you've got the consumer, two-thirds of economic growth, which seems to be doing very well. The consumer is spending, sentiment is up. So how would you characterize things right now, and are you expecting a recession at some point?
Well, all right. So
over the near term,
let's take
not
that
at some
piece.
point.
Yeah, let's take that piece by piece. You said the consumers are spending, and I think the spending by the consumers still reflects what we're seeing in labor markets. Labor markets are still strong. Unemployment is very low. Employment is relatively high. Even wage growth looks pretty good. So all of those things feed directly into consumer spending, and I think that's what we're seeing. If you're thinking about the future, the numbers that you talked about this morning, the ISM, well, you know, while they're not, they don't necessarily predict what's going on. They are indicators of a slowdown. And to my mind, the most important indicator that I've seen over the past couple of quarters is investment. So we had a couple of very good investment quarters in 2017. We're not quite there right now. And so if I'm thinking about the future, those to me are the most important indicators. Now, you said, are we going to have a recession? Again, I'd go back to what I said earlier. We know we're going to have a recession at some point because a recession just means that we've peaked and we're past the peak. So we know we're going to have a recession at some point. I don't think markets are telling us that a recession is imminent, that it's something that we're going to see in the near future, meaning the next 2 to 3 quarters. But over the next 2 to 3 years, I would say it's certainly 50%.
Well, we are on year 11 of this expansion. I get that. Real quick, we got the jobs number out on Friday, and then a Fed meeting on the 18th this month. What are your expectations for the jobs number, and do you think the Fed cuts rates on the 18th?
Well, I think the jobs numbers, I'm always terrible at predicting, but if I have to give you a prediction, I would say somewhere in the 150,000 range. That's about where we should be right now at this point in the cycle.
That's pretty much where the economists are, too, 158.
Yeah, so, but We're maybe slightly worse than weathermen, but you know, I'm not sure how we are in terms of
what
forecasting.
About the Fed,
in terms of cutting rates, you know, I'd be very surprised if they don't cut at this point. All the numbers seem to be moving in that direction, so I would expect that they're going to cut.
All right, we will see if it's another 25 basis points. The president's talking about 1 point over time. Ed, it's great to see you this morning. Thank you so much.
Thank you, Marie. Always a pleasure to be with you.
And to you, Ed Lazear, joining us this morning.